Welcome to the Net Wealth Nest podcast, the show that helps everyday people build real financial stability, starting from wherever you are. Whether you're working your way out of debt or just starting to save, we're here to help you grow your net wealth to your first big wealth milestone. Each episode, we break down the mindset shifts, practical tools, and real-life actions that can transform your financial future. Thanks for tuning in. Now let's get to work building your net wealth nest. Welcome to Net Wealth Nest podcast. I'm your host, Jim LaBeouf. Today, we're going to take a deep dive into a topic that we've covered a little bit before, but more at a high level. And we're going to talk about credit cards today. We've talked about credit and debt and how to utilize different types of credit and different types of debt. But today we're going to spend some time specifically talking about credit cards, and we're going to talk about some of the things that people mistake or don't understand about them. And then we'll talk about paying them off. And lastly, when you get to the really good zone is when you're paying your credit cards off every single month, how do you maximize maybe some rewards on your card that might be offered to you? So first, we're going to talk a little bit about a few things that people really struggle with when using credit cards. Many people get credit cards and then use them and aren't really keeping track of what they're using them on or how often they're using them or how much. And all of a sudden they get the bill or they feel like they're starting to spiral out of control, and it can drive a lot of anxiety around that debt. And really, that boils down to a temptation to overspend, especially if you get higher limits sometimes, where we're bombarded with so many different types of advertisements through social media, through TV, through radio, any of that stuff, that there's just always something cool and new and better and something that's going to make your life more awesome always out there. And it's really hard to say no in some of these circumstances, especially if you have a credit card with a solid limit on it and the ability to use it to purchase that. And then with as easy as it is to purchase things on the internet, in some cases one click, that can go really quickly. And when people do that, they get that anxiety when they get the bill. And then they also find out that the interest rates on these things are sometimes astronomical. Even with good credit and a really good credit card, because there are different types of credit cards, you're still talking an interest rate around probably 15%. And that's a good interest rate on a credit card. Now, I'm recording this video in 2025. So depending on when you're watching it, that might have changed, but that's where if you were to get a credit card today, somewhere around 15% would be a really solid interest rate. And they can go as high as I've seen 23, 24% on some of these cards with maybe not perfect credit or those types of things. And so understanding that interest rate, if you're not paying off the credit card, is really setting you back from generating wealth, long-term wealth, and being able to use your additional money to invest or to buy assets or any of that type of stuff. And that interest is calculated basically on a monthly balance. So if you buy something on the first of the month and you don't pay it off by, let's say, the 30th of the month or 31st of the month, it's usually a 30-day cycle, you will start accruing interest on that. And again, those interest rates vary depending on the card and depending on your credit rating. But that's just extra money that you're paying for something that you probably either should have bought in cash or you shouldn't have bought at all because you couldn't afford it at the time. And so that's first and foremost, is if you're carrying balances on credit cards, that we consider the first thing you should get rid of, is try to get rid of all of your credit card debt as fast as you possibly can, because it will hold you back from building your wealth. So how do you do that if you have that? And what are some options and ways? First of all is you've got to keep track of everything that's going on. This is the biggest miss that people have, is they aren't keeping track of maybe even how many credit cards they have. The average person has somewhere between 3 and 6 credit cards. They're not keeping track of what the minimum payment is, what the interest rate is, when is the bill due, those types of things. And sometimes when you do that, you can get late fees on your cards, or sometimes you sign up for cards that have annual fees where all of a sudden once a year you're getting charged $100 or $200. And that only makes sense to have a card like that if you're taking advantage of the rewards that come with those types of cards, and they're outpacing the amount you're paying for the card yearly. And more often than not, most people who are paying those yearly or annual costs are not utilizing the card to its fullest extent and are actually ended up paying to use a credit card and then paying interest on anything they carry on that credit card. So it's like a double whammy. So if you could stay away from that, stay away from annual costs, and then make sure you know when the card should be paid. You can stay away from late fees. That is a great first step. The other thing we recommend is write it all down some way on a computer, on a piece of paper, whatever. Write down what cards you have, like what they are. Is it Chase? Is it a Discover? What is the balance? What is the interest rate? When is it due? What is the minimum payment on it? And get all those set up so you know exactly what cards you have, how much is on them, and when they're due, and what you have to pay minimum for it not to be late or to ding your credit at all. Because the other thing you don't want to do is you don't want to start not paying these and then have your credit rating go down. It's going to make it harder to get loans in the future for things that are worth maybe taking out debt for, things like a mortgage or even a car. You don't want a low credit rating because that's going to hurt your feasibility to be loaned to in the future, or sometimes it'll drive up your interest rate as well on the loans you do take out. One question I get asked quite a bit is around transferring balances. And this can be a strategy to be used to help with an interest rate that is maybe really high. Let's say you have a card that has maybe a 19 or 20% interest rate, and there is a card out there you get an offer, and we all get them in the mail, this junk mail is 0% introductory rate for 12 or 18 or 24 months. Some people do utilize that to move their balance from one card to the next and then try to pay down as much of that debt as possible. There's a couple of kickers when it comes to this. The first one is, more often than not, there's a fee to do that. So it could be a 1, 2, 3, 4% fee, which again may make sense in the situation you're in, but that is only provided that you can pay off the card before the 0% interest rate introduction ends. If you don't, more often than not, those cards will all charge back interest. So they'll be calculating the interest as you pay off the card during the 0% fee. And if you don't pay it off, they add all that interest from that 12 months, that 18 months, whatever, onto your card, and you end up paying it anyways. So the key is, if you are going to do that, make sure it makes sense. Do the math on it. Can you pay it off? If it's 12 months, can you make sure in, let's just say 11 months, that card is 100% paid off and you're going to add anything else to that card? Know what the fee is to transfer. Does it make sense for you to transfer it as well? Beyond that, then it's just deciding how you're going to pay off your cards. And you'll hear a lot about two different methods. One's called the snowball method and one's called the avalanche method. The snowball method is really simple. You take all your cards and whatever the lowest balance is, you work to pay that one off first. So you make the minimum payments on all your other cards, but that lowest balance card, you put as much money as you can towards it. So let's use an example that we've used in the past. Say we have 4 cards. It's a $2,000 balance, a $1,000 balance, a $500 balance, and a $250 balance. And we're currently paying $50 is the minimum payment on all of them, but we have $250 that we could pay on the cards. So what we do is we take $50 on all of them, and then we add $50, so we're paying $100 on the one that has the balance of the smallest amount, so the $250, and we do that until we pay it off. And then what we do is we take the $100 that we were paying on the $250 balance, which is now gone, and we move that to the $500 card plus the $50 that we were already paying. So now we're up to $150 that we're paying on that $500 balance. And we do that until we pay that one off, continuing to do the minimum payments on the other 2 cards, the $2,000 balance and the $1,000 balance. Once we pay off the $500, we've got that $150 that we're paying. We're going to move that to the $1,000 balance. And now we're paying $200 on that $1,000 balance, and then $50, which again is the minimum payment for the $2,000 balance. Continue to pay off that $1,000 card, and then finally we go and we have the full $250 working for us towards that $2,000 balance. And this is a way to quickly pay off that debt instead of trying to spread it all out, and making sure that we are on a strategic path to pay off that debt. The avalanche method is essentially the same thing, except the difference is, instead of paying off the smallest balance, you're paying off whatever the largest interest rate is first. And the thought process behind that is, the one with the highest interest rate, you're giving the most money to the bank. So the faster you pay that one off, the less money you have to give to the bank, and so on and so forth down the line. Most people end up going with the snowball, and the reason that is as human beings, we all love instant gratification. We like that dopamine hit. And when we pay off that first card, we get that dopamine hit of accomplishment and that we've done it. And so getting it quickly and then seeing it steamroll, people tend to be more successful with the snowball method than the avalanche method, because many times the higher interest rate cards aren't necessarily the lowest balance and take longer to pay off. And so people sometimes start that process, but they don't complete it. The key is to complete the process so that you can get all your debt paid off. Now, there are some people out there that once they get their debt paid off, they've gotten their spending under control, maybe with a budget or any of those things, they may still have a credit card that they use. Now, just to be really transparent and clear, if you struggle to hold back your spending, personally, I would just not have a credit card. I would just use a debit card or use cash and not have the temptation to spend and put myself back in a hole that I maybe just climbed out of. However, over time, if you can break the habit of spending and keep your costs and your spending in check, utilizing a credit card will give you some advantages when it comes to things like rewards or even like extended warranties and those types of things. But again, you have to make sure that you're paying off the card before every statement happens, because you do not want to accrue any of the interest on the card. So if you get to that point, there are a couple things you can do where you can get a card and maybe it's for miles if you travel, or just travel dollars or cash back, those types of things. Maybe you're using it for gas. Just a personal experience, I pay my cards off every Friday. So I use a couple of different cards, one for my business and then one for my personal spending. And as I spend on those cards, whatever they might be, I make sure that every Friday I pay that card off. And that way I'm never going to accrue any interest on that card, because I'm always making sure I have enough in my checking account to pay that card off on Friday. And then I take advantage of it. My personal card has points where I can use those against travel, whether it be airfare, rental cars, or hotel stays, where I can use those to get free nights or money off my rental car, those types of things. And they end up paying for itself. And I end up getting that reward because I'm using that bank's card, even though I'm not paying them any interest. I'm just using it as a temporary solution to pay for things. Again, this can be really a great thing to have, but you've got to be in the process or in the mindset that you are not going to overspend. You're not going to carry a balance over 30 days, and then it's going to be paid off. And then you can go ahead and utilize a card for rewards. The last thing I'll talk about too is making sure that you're balancing your utilization rates to help your credit score. So what most people don't understand about credit scores is part of your credit score takes the amount of open credit you have versus the amount that you're using or have purchased stuff with. So just to give you a really easy example, if I have a credit card that has $1,000 limit on it and I have $100 on that card that I bought whatever with, gas or food or whatever, I have a 10% utilization rate. The higher my utilization rate is, the more risky I am to anybody who's looking to lend to me. And so that actually decreases my credit score if I have a really high. So if I had $1,000 card and a $900 balance on it, I would have a 90% credit utilization rate. And that would be much riskier to a bank or a company that wanted to do a loan with me than it would the opposite way if I only had $100 on it. And so I'm much less either likely to get a loan, or I'm going to get a higher interest rate on a loan than I might be applying for. It's about risk and reward when they're looking at that. So understanding, and again, if you pay it off before every 30 days, you'll always have a 0% utilization rate. Anything under 5% is what the credit agencies consider excellent. And so if you can get your credit utilization rate under 5%, you're going to be in a really good spot, and that's really going to help out your credit score. That's all we have for today. We just wanted to cover a little bit more in depth about a topic that we had talked about in the past and really give you some more ideas on credit cards. Please feel free to ask more questions in the comments, or if there's more that you would like us to dive into in the future, we can obviously continue to do future shows on that. We can talk more and more about credit. If you're on the path to building your wealth, I highly encourage you to stop at our website, netwealthnest.com. We do have options to help you. We know that sometimes people need communities or accountability to really move the dial on some of these things, especially when we talk about building wealth and managing money. We do have options for those. We have a private community that you can join. There's a monthly fee for that, but it's about peer sharing and holding each other accountable accountable and sharing victories and sharing questions. Our admins go in there and they put in different things and challenges for you to work on each week and all these different things to help you move the dial on your wealth building journey. And then we also have one-on-one coaching for those that are really serious and willing to make an investment in their future and really build wealth quickly and efficiently. We have one-on-one coaching where you're meeting with a coach and you're going through your finances and they're holding you accountable and challenging you and helping you raise the bar on a one-to-one basis and make sure that you obtain the goal that you want. Again, if those are things that you're interested in, we do offer that. Thanks again for stopping by our channel. If you liked what the content, please subscribe to our channel. Please follow us. We'll continue to put out content so that you can grow your net wealth. Bye, everybody. Net Wealth Nest LLC and Podcast is an educational platform committed to providing resources and information to empower individuals on their financial journey. Please note, we do not provide financial, tax, or investment advice. All financial decisions should be made in consultation with a qualified professional who understands your unique circumstances. Seeking personalized advice is a smart and necessary step before making any major financial commitments. Thanks so much for joining us today. If you found value in this episode, please like and subscribe to our YouTube channel, Net Wealth Nest, and leave us a review on your favorite podcast platform. We read every comment, and they help us improve and guide what topics we dive into next. And hey, if something you heard today resonated with you, don't keep it to yourself. Share it with a friend, a family member, a coworker, your barber, your barista, even a stranger in line. You never know who might need this message. Remember, building net wealth is a journey, but you don't have to do it alone. Stick with us, and together, let's grow your net wealth nest.